Today, guys, I have with me Kevin and Mike. They are with Pine and Co CPA. They work with physicians, real estate investors, small business owners, short-term rental owners around the country. So excited to have you guys on with us today.
Yes. Thank you
so much. Thank you. Thanks for having us, Param.
Thank you, guys. I truly believe that tax planning has to be part of everyone's wealth strategy, right? There is the magic of compound interesting and there's leverage, but tax reduction, I think, is a big part of should be a big part of your wealth strategy. So I'm excited that you guys are on here, and I'm really hoping that we can talk about real estate investing and the tax benefits, and maybe even talk about the ways physicians should be thinking about corporations and entities later on. But just to start off, if you guys can just go over, you work with a lot of real estate investors and many of them are physicians. So if you could just go over the tax benefits that the tax code affords to real estate investors.
Sure. So there's a lot of caveats in the IRS code to allow for utilizing real estate to offset your physician, other active income. There's certain hurdles we have to kind of jump over before we can get there. But with the right advice and the right team in place, coaching, attorneys, accountants, insurance, you have all these people around you to build a team, and you have different people giving you advice on specific subjects. We're able to hone in on this tax code and utilize it for your benefit. A lot of it's going to be segmented around bonus depreciation, utilizing depreciation to push you more into a taxable loss on real estate property, not a cash loss. Now, there's a difference between a cash loss and a tax loss. We always want your real estate to be cash positive, but with creative accounting, we can push you into a taxable loss. And so we can kind of get more into that a little bit later of how that's done. So we're really excited to talk about this. And this is Mike and I's passion. Most of our client base are physicians getting into real estate to try to be phasing out of that kind of rat race of just always working and utilizing just smarter investing strategies to build wealth and find just freedom.
Absolutely. And I like what you said, Kevin. It's all about strategy, right? Because, you do have paper losses in real estate. You're actually generating positive cash flow, but because of depreciation, you end up getting paper losses. So your cash flow from rental real estate is most often, if you structure it correctly, it's going to be tax-free. But, you talked about how if physicians want to use real estate to actually shelter clinical income, then there are hurdles that they need to cross. Like, it's not automatic, right? So can we go into that a little bit? Can we talk about passive activity loss limitations when it starts phasing out, and what physicians can do to strategize around that?
Yeah, and that's very important, because as a full-time physician, you're going to have to, and if it's just you, now if you're married, we can kind of get into the strategy of utilizing your spouse to get into real estate to offset some of these hurdles. But there's two trains of thought and two types of real estate. The first one being long-term real estate. That's going to be your year-long leases, kind of your traditional leases. The second one's going to be your short-term real estate, your vacation rentals, your Airbnb, VRBOs. Those are going to be your 7-day leases or less. Average lease time needs to be 7 days or less. There's hurdles for both. And as a full-time physician, you're going to probably utilize the short-term real estate more than the long-term real estate, but we can get into how that is. So in long-term real estate, there's two hurdles. The first one you're going to have to pass is being a real estate professional under the IRS code. And what that entails is 750 hours of qualified real estate activities each year, and over half your working time has to be in real estate. So if you're pulling 2,300 hours as a physician, there's just no way over half your working time is going to be in real estate. So that's where a spouse can come in, because if you file jointly on a tax return, your spouse can qualify as a real estate professional. We could utilize your physician income to invest into long-term real estate and utilize the real estate professional designation. So at that point, there's a little roundabout way you can utilize it. So assuming you meet hurdle 1 of real estate professional, hurdle number 2 is material participation. So that means even though you're a real estate professional, if you're not actively involved in your rental properties, you're not going to be able to utilize those losses to offset your physician income. So there's actually some really good strategies involved around material participation when dealing with long-term real estate as well, meaning you can have multiple rental properties and we can make an election on your tax return to group all of your rental properties into one activity. So you don't have to materially participate in each single home, but instead just materially participate in the group. And material participation, and I can get really granular with it, but it's a 7-part test. And to give you an idea of what the IRS is looking for when it comes to material participation is you only have to pass one of the 7 parts. The baseline safe harbor is 500 hours managing your property. If you spend 500 hours managing, talking with the tenants, doing your self repairs, you can do your own repairs. 500 hours, you're going to be, no questions asked, you're going to be a material participant. Now that rental property is no longer a passive activity, but an active. The second one would be 100 hours. So you could do 100 hours on that property, but you also have to produce more time than anybody else on that property. So if you have a management company, then more than likely you're going to be passive in it, because if you have someone managing the property, I'm not sure what kind of active work you're doing on the property. So those gives you kind of some ideas, and there's 5 other tests, but that'll give you some idea of what we're looking at when it comes to material participation.
Yeah, and you were absolutely right about that, Kevin. The way you look at it is it's different for long-term rentals and short-term rentals, right? And with long-term rentals, we need to meet you need to qualify as a real estate professional status and hit material participation, which can be hard for someone who's working full-time. And like you said, that's where you bring a spouse in, possibly who's interested in doing it, and then you tag team and you make it work. With short-term rentals, like you said, it's completely different. If your average stay is 7 days or less over the course of the year, then you just need to meet material participation, right? You don't have to jump through that loop of real estate professional status. Now, so once someone is strategizing around this, could you talk to us also about bonus depreciation, which is something that we got with the Tax Cut and Jobs Act, right? So, and how that's been helping real estate investors.
Yeah, so the Tax Cuts Job Act was really pro real estate. And this is bonus depreciation. It's basically taking an asset that has a useful life of greater than 1 year. And so under IRS code, if you go buy a house, you have to depreciate that over 27.5 years. But there's ways that we can get bonus depreciation, which just means instead of depreciating it over a long life, 27.5 years or 15 years, whatever the class is, the IRS allows you to actually front load your depreciation into the first year. So if you buy a $10,000 improvement to your property, you remodel a bathroom, typically you're going to have to depreciate that over 15 years. Well, with the Tax Cuts Job Act, that $10,000, instead of getting that little deduction each year, we get to take it all in 1 year. And so that's where we kind of circle back to, I can get you a paper loss on your tax return via bonus depreciation. And assuming you meet material participation or real estate professional hurdles that we just talked about, that's step 1. Step 2 is then get into a loss. Now that loss can offset your physician income, that bonus depreciation. So it's a great strategy.
Yeah. And oh, sorry, Mike, go ahead.
Yeah, thanks. I was just going to add, in a lot of cases, when you're starting off, it's hard to get into an active real estate professional situation where you can only get active depreciation or offset your active income. Passive losses aren't a terrible thing either, as long as you're cash flowing positive. So if you have passive income producing properties, your passive losses from other passive loss producing properties, again, tax loss, not cash loss, can help offset those. And also just investing in, whether you're starting in a syndication or investing in someone else's syndication, if you're passive, bonus depreciation is still an awesome thing. It might not be able to reduce your physician income or your other active income, but what it can provide is tax-free distributions. So if you get a net passive loss, let's say you invest in a property, but you're not a real estate professional, whether you own it or you invest through a syndication, you're going to get allocated some bonus depreciation if you take the steps to do so, and Kevin can walk through those in more detail, but you'll have this net passive loss. And if you don't have other passive income to offset it with, it sits there as a net operating loss, except the net passive operating loss or net passive loss. And it carries forward indefinitely. And it can carry forward as you produce operating income, it can offset that income and eliminate it. So you have zero taxable income, but hopefully have operating cash flow distributions either from your own property or your syndicated property, or if you're a syndicator and looking to get syndicate, you can offer the same opportunity to your investors as well.
Yeah, you're absolutely right about that. And the funny thing is, I hear people all the time say, well, they're passive losses and I'm not going to be able to use them. So they don't make the effort to log it or maximize their passive losses. A very valid point over there. You really need to be doing that because they're just suspended. You're not losing them and you are able to use it, at some point. So just as a, just a follow-up question to that, Mike, how do these passive losses get freed up? How and when do they get freed up and when do they actually convert into active losses?
Sure. So they won't get converted into active losses. Once passive, they're always passive unless and until you dispose of the asset. When you dispose of the underlying asset, it's freed and it becomes an active loss. So if you have a house, you buy a single family residence house, you do take bonus depreciation. Let's say you have $100,000 passive loss carry forward. You go into the second year and you sell it. Let's say you sell it for break even. You don't have a gain to offset it or any income. You break even. Now you have $100,000 active loss that can be freed up to offset your other active income. But again, the other way we most commonly see it used, and one of the more powerful ways, is as you're growing, especially for those physicians who are trying to build an income producing, freedom enhancing portfolio. Those passive losses can offset any other passive income in similar type investments, as long as you know to group those properties and file the proper election with your tax return so that they're all aggregated and losses are offsetting income from other properties. But you have to file that election, and that is one of the more common mistakes Kevin and I see with new clients coming into us. That election has not been filed, and it's a shame.
Yeah, yeah. And then I just wanted to ask about one more thing while we're talking about this. Now, with physicians, some of them own surgical centers, endoscopy centers, and there's and you've probably done this with a lot of your clients. Some of that income can be, structured in a way that it's actually passive income, and then that could be used to offset passive losses from real estate.
Yeah, I think you're getting into shifting rents. If you own your own center, that as long as we have market rents and you own the building that you operate out of, yes, we can definitely get creative and we can get aggressive with the rental agreement that you have essentially with yourself. We could shift income from your business, your practice, shift it into the building, and then we can accelerate some depreciation over here. So essentially, we're taking income from your business, shifting it over to your surgery center, the actual building, and then because of depreciation, you're not going to pay any tax on that transfer. So as long as you have your good rental agreements and they're marketable, I mean, you don't want to just go out and go crazy and go 20,000 a month is my rent. It's not market. The IRS is going to kick it out. So we have to be reasonable, but that's where your team of attorneys, accountants, that's where we come in.
Right, right. Absolutely. You're absolutely right about that. And, it's all about timing and about having the right people and having the right structures in place instead of going retroactively and trying to do something that's just not going to work. Kevin, while we're talking about short-term rentals, so a lot of our members invest in long-term rentals, short-term rentals, syndication. So when we're talking about short-term rentals, we talked about material participation, right? And we talked about an average stay of 7 days or less over the course of the year. What other things do people need to remember when they're trying to, acquire a short-term rental and bonus depreciate, right? What are the rules in terms of placing it in service before the end of the year? Other things that they need to keep in mind?
Yeah, a common question I get is how long do I have to hold the property until I can get depreciation? And the answer is I just need you to have it rented, at least try to be rented. What the IRS says is that it has to be available for use. And Mike and I, we live in the gray area of the tax code. We feel that most CPAs should. If you're too conservative, you're paying too much tax. If you're too aggressive, you're probably a little too risky. But we want to be in that gray area where what is available for rent or in service. And I classify it as if you have a rental property and you close on it, let's say December 1st, you do a little repairs, fix up, and then by December 20th, you just put it on Airbnb or VRBO, you are ready to go. I would take that as, okay, this is an asset placed in service in this tax year, even if you rent it or not, because I can defend in front of an IRS agent. They tried. I mean, we had it on the market. It was available for rent. It was in service. This asset was ready to go. We just didn't get a renter. Ideally, we want at least a renter in there and have some cash exchange. That just tightens everything up a little bit. But we can make an argument that in service just starts when it's available.
That's great information because this is a common question we get all the time.
Yeah.
Now, we also talked about syndication. We talked about how passive losses and syndications, how you could optimize it and actually use it to your advantage. Many of our members, invest passively in syndications, are also doing active, are also owning real estate actively. So I wanted to talk about the 9G grouping election that you guys mentioned and say, so if you are able to meet, real estate professional status and material participation, is there a way that they can group their syndication, along with their active real estate portfolio using that election and then convert those syndication losses into active losses if they're meeting all the criteria?
Yes. So you hit on the key point, as if you just invest only in syndications and you're not active in the management of the fund, you're not managing the multifamily deal or the syndication, you are passive. The key is going to be, one, to reach that real estate professional designation, and two, to materially participate in some other long-term real estate, meaning maybe you have a duplex that you own and you actively manage it. You meet material participation there. Now we do exactly what you said. We make that election. We group your duplex in with your syndication, make it one activity because they're like-kind long-term rental activities. You can do that. Then, now the bonus depreciation from your syndication deal, I can have an argument saying once we group them together, now all your losses are together as active losses. Now, the only caveat to this, and it gets kind of confusing to when you just read the tax code, but with short-term real estate, you cannot make a grouping election with short-term real estate. So if you materially participate in an Airbnb or VRBO and invest in a syndication, I cannot make that election. So what happens with short-term real estate is you're actually taking the position you're not in real estate at all. So that's how we're able to get around the real estate professional designation hurdle, is because we're saying you're not in real estate, you're functioning in active business. You have started a day-to-day rental business, and the passive losses related to real estate don't apply to you. So that's how we can't make that election, but with long-term, you most certainly can.
Yeah, and that's a great point. And this is a question that comes up all the time also. Your long-term rentals are very different from your short-term rentals, and you can group all your long-term rentals and you can group your short-term rentals, but they can be combined. Now, how does it work for material participation and real estate professional status? Do the 750 Rs have to come just from the long-term rentals and just from the short-term rentals, or can you combine those Rs for your reps and for material participation? Well, actually more for real estate professional status than for material participation.
Yeah. So real estate professional designation is, you can actually include more hours in that than what you would with material participation. So what real estate professional hours would be, you can even include market research. You can get your realtor license and the time spent with education and getting all these certifications, and we could be a lot more wide and broad with what constitutes as to that 750-hour real estate mark. When you get to material participation, that is going to be participation on a specific property. So you doing, and we can kind of talk about, does time researching this property I bought, negotiating, but you actually bought the property, does that time count? I would include it. So material participation would be the actual management of that property, talking with the tenant, fixing it up, those sorts of things. When you actually have a property and you're working it, all time outside of actual material participation can go towards your 750, but actually your material participation hours on your long-term can actually count towards the 750 as well. So there's kind of two different buckets of time you have to track. And that's another point, is tracking your time is very important. So like as a CPA or an attorney, we do everything by the hour. You almost have to think of yourself in that mindset, to where if you sit down and work on your rental property, you're going to say, okay, it is January 20th, 7 p.m. I worked from 7 p.m. to 9 p.m. And you put the date, time, and description of what you did. You make a cumulative log. And then that's going to be our defense if the IRS ever challenged material participation or real estate professional status.
If I could just kind of go back to the area of difference between real estate professional rep status versus short-term rental, and how they're differentiated. And I think understanding the history of the tax law helps kind of clarify, because we get a lot of clients and even a lot of CPAs that have come and spoken to us that don't really understand why they're different. The law started off with vacation rentals was a real estate professional activity. It used to be that way.
Mm.
And 8 or 10 years ago, as Airbnb started getting larger and larger, there were a lot more people claiming real estate professional status. And it was aggravating people at the IRS and the Treasury Department. They lobbied Congress and said, hey, there's too many real estate professionals. These guys aren't really real estate professionals. They got a vacation rental. That's more like something else, a hotel or something. That's not a real estate professional activity. So Congress agreed and they passed a new law that flat out says any property that has an average lease length of less than 7 days is not a real estate professional activity, which I love America. I love our Congress. I love the IRS because they thought they fixed it. But what they did was open up a whole new world of depreciation for people that otherwise couldn't qualify for it. I thought it was brilliant. That's not their intended consequence, but I love the consequence, and our clients do too, and I assume you do as well, Param. But because of that, anytime you spend on your short-term rentals or vacation rentals can't go into the same time bucket that you're trying to qualify for rep status. That 750 hours has to be on real estate professional activities. It can't be on short-term rentals. And your short-term rental time that you're tracking for material participation can't come from your rep time. Now, there's a lot of time that is gray area. And as long as we can argue it with a straight face in front of the IRS that this time was for whichever your intended activity was, then we're likely to get away with it. And then finally, I would just add to Kevin's comments on tracking your time. One of the bigger mistakes that we see with clients that are claiming either reps or material participation, not to pick on physicians, but we see this a lot with physicians because you guys are so darn busy and you've got bigger things to worry about, like saving people's lives versus keeping a time log. But it gets to be September, October, and we ask them, hey, how's your time log going? And they're like, I did really good through January, and then I kind of dropped off. And we say, okay, well, let's try to work on recreating it from scratch. It is so hard to remember what you did 2 days ago, much less 10 months ago. So we strongly recommend that you keep an active log, and there are tools that you can do it. I mean, Kevin and I are accountants. We like Excel. That's probably our preferred method, but a lot of our clients, they're not big into Excel, or they're always on the move, and it's not easy to use Excel on your phone. So we recommend apps like, whether it's QuickBooks Time that comes with QuickBooks Online, or T-Sheets, or sorry, not T-Sheets anymore, that is QuickBooks Time now. Clockify, some kind of app that is built to track your time. If it's going to help you actually track it in real time, it's important. We recommend that.
Yeah, that's great, Mike. And that's what I always recommend to members within the community also. Just do it as you're going along, because if you have to go back and do it, you're going to miss a lot of hours, and it's going to seem fabricated, right? So let's just, as we're talking about that, let's talk about audit proofing your records, right? For a real estate investor. So just a few tips that you would give to someone. We talked about the app, right? And I think I use the app a lot. If I had to do it on Excel, I think it would be harder for me. And that's a great tip. But other tips that you have for our real estate investors in terms of, keeping logs accurately, this way they protect themselves when it's time for an audit.
Yeah, it's very important. So receipts, typically that's going to be the proof that you had any expenditures that are a credit card statement. So we always recommend, when you buy rental properties, we would always seek the advice of counsel, an attorney, a licensed attorney who can give you legal advice. Mike and I aren't attorneys, but we've been in rooms with plenty of them. And they typically advise that you start an LLC or a series LLC, develop a good structure to start. Once you get your LLC, get your own bank account, because if you're going to get audited, and it's going to be a lot easier to defend the audit once we know all the income and expenses of this rental property came out of one bank account and one credit card in this LLC. If you commingle with your personal assets, I mean, the IRS agent could say, yeah, you went to Lowe's and spent $500, but you also have a nice grill. So how do we defend it? So it's really going to be good to make sure that we have good accounting records, a good structure in place. And, as you start to get more aggressive in this depreciation, and even though it's aggressive, but it's all under the IRS code, and we're going to tie everything up in a nice little bow, and we're going to do our due diligence with the reporting and the tax return. But that does increase your audit risk, only because you're now going to have this huge loss from bonus depreciation that you're going to be offsetting your income. The IRS it's going to raise some eyebrows. So we want to make sure in the year that we do this cost seg that kind of all of our ducks in a row, and talking about the time log, making sure that you have good records, checking records and books, and making sure, we're not scared of audits. I don't take positions on tax returns. avoid strong positions on tax returns just because of an audit. We utilize the code and we're ready to defend it. And so it's just all a matter of being aggressive, but also obeying the law. So it's balancing those two things. But being audited necessarily isn't fun, but it can be easier with the proper help.
It can be a lot easier.
Yeah.
Yeah. I would also add that, just to add to some of Kevin's comments. So like some of the things that you're going to do, especially in short-term rentals, but also long-term, but particularly just to kind of make an example for vacation rentals, some of the time you're going to spend to qualify for material participation is market research, which can include going out and finding the best restaurants to recommend to your guests, or the best jet ski rental place, or downhill skiing rental place, or tourist or tour operators, depending on wherever your place is. And it can count for long-term rentals too. So you're going to use that for your time, but in order to use that for your time and take the deductions, to be able to deduct those dinners, to be able to deduct that jet ski rental, try to add something about the places, either why to go there or why not to go there, either in your listing or in your guest book or in some kind of record or communication to the ultimate people who are paying you revenue. And that way you can prove a business intent. You had an economic intent to earn profit by going to that place and spending that money and spending that time. So just try. I mean, you doctors are great at it. Y'all chart everything when it comes to your patients. Do it for yourselves as well in your businesses. Treat your business like you treat a patient. Yeah.
Such valid points, Mike and Kevin, and that's where the importance of having a real estate savvy CPA comes in, right? And I've had CPAs in the past where we've made mistakes in terms of how they recorded the basis. Partial asset disposition was never even accounted for, and I've had members within the community where depreciation hasn't been taken. It's just crazy. So what mistakes do you commonly see when people with people who come in where they've had a prior CPA wasn't very real estate focused, so just to give a few examples of how important it is to have someone who knows what they're doing as far as real estate investing is concerned.
Yeah, I think one of the craziest I've come to in over 14 years of practice is we had a client who came to us. They did everything right. The client did. They got the cost seg. They bought the right property. They did everything they were told to do, gave the cost seg to their CPA. The CPA didn't even take bonus.
Wow.
So I looked at the tax return. I was like, you got a cost seg on this house? And yeah, I'm like, well, there is no loss. Like you are barely, you should be seeing way. And so we had to go back and amend the return. We actually talked with that CPA and he fought with us about it. It was the craziest experience I've had in practice. So it happens. You can do everything you want and you should track your time, do all this stuff, but you hand it to a CPA who's not focused in real estate, does not understand material participation, does not understand a real estate professional. You could have 4 long-term rentals and he has no idea that your spouse is running it. He has no idea that you can make an election to group it. He has no idea you can maybe do 4 cost segs now, and then now you can deduct all the depreciation against your taxable income. So it's very common. Real estate is a very niche part of the IRS code, and there's a lot of fun things in there that we can kind of play with. So yeah, I have seen my fair share though of the state.
Yeah. I think the grouping election, like Kevin mentioned, the ability to take active status if someone qualifies as a rep for long-term rental. We see a lot of CPAs that still don't believe in on a short-term rental. If you materially participate and you're not a real estate professional, you can take the depreciation. And then another big one that Kevin and I have been running into a lot with newer clients is CPAs that don't pay attention to your lendability. If your goal and your focus and your financial plan is to grow in your real estate portfolio, and you're doing it through leverage, which you should do with as cheap as money is today, although Kevin and I are strong believers of fixed rate mortgages, especially today,
Yes.
but very strong believers in it. But if you're planning on growing through leverage, your CPA needs to understand what lenders are looking at when their underwriters are looking at. And one of the biggest mistakes that we've seen, and quite honestly, a while back, we used to make it too because we didn't know it, but we did a cost segregation for someone who finally had become a real estate professional. So we took a bunch of prior catch-up depreciation on his tax return. The IRS says, well, you should put it on an other deduction line on your schedule that's reporting your depreciation. Well, then he went to go file for a mortgage or a refinance, and the lender's like, your debt to income is too low. And he said, but that $300,000 expense, that's depreciation. And the lender said, no, it's not on the depreciation line. We argued back and forth with that lender, and they wouldn't accept it until we amended the return and put on depreciation. So now we focus a lot of time making sure anything that can potentially show up on the depreciation line, especially while we have 100% depreciation, it goes on the depreciation line. So you don't have qualms with your lenders. There's other small items like that that can add up and make a difference. But repairs and maintenance, as long as we have 100% bonus, and probably next year, if you're focused on growing through leverage, even when it's 80% bonus depreciation next year, or potentially even 60% in 2024, before, in my humble opinion, we're going to get bonus depreciation back 100% because our economy needs it.
Yeah.
But anything that you can move and claim, this has a useful life of greater than 1 year. Repairs and maintenance, we normally as CPAs, when you're just focused on the tax dollar, you throw it in repairs and maintenance, you get the tax deduction. But if you can throw it to a capitalized asset and then deduct it as bonus depreciation, suddenly it doesn't impact your debt to income. As a matter of fact, it improves your debt to income ratios, which helps lendability a lot. So most CPAs, and they don't teach us as CPAs to care about lendability. When you're focused on tax, you only focus on tax income and reducing your taxes. But you as a real estate investor need to focus on lendability as well if you're using leverage. And that's a big mistake we see a lot. CPAs that don't care or don't know.
Yeah, I think that's a very important discussion to have with the clients before you go ahead and file their taxes as such, so that you understand what their goals are, and if that's something that's going to be important to them, that's going to affect their lendability. You really want to plan accordingly, and that's such a valid point. So time and again, you guys, everything you've said, it just highlights the fact that timing is so important with these strategies, and just planning ahead of time. Now, Kevin and Mike, I know that you guys offer not just tax filing, but tax planning services also, right? In addition to preparing taxes.
Yes. So we are a tax only firm. Mike and I, we used to be your traditional CPA firm. We would offer you accounting, payroll, tax. If you needed anything, Mike and I would jump through a hoop, learn it, figure it out. We have come to figure out that really that's not the best way to service our clients. The IRS code is getting way too complicated. The IRS code is getting thicker and thicker. So the best way Mike and I have found, and our passion, is tax strategies, finding these little areas, gray areas in the IRS code and living in those, where otherwise, if we were more generalists, we couldn't. So yes, we are a tax only firm, but if you need accounting services or payroll services, Mike and I will have solutions for you. But we really focus on tax planning, tax structuring, and compliance. All of those are very necessary and need to be all done under one roof, so that we make sure this machine is going forward in the direction it should, and you don't have different professionals kind of piecing in parts to make it go. We want some sort of control and making sure that it's done properly.
Yeah,
Kevin,
awesome.
and our favorite kind of clients, our favorite clients are ones that have worked with us throughout the year to proactively tax plan.
Mhm.
The clients that call us up on January 8th and say, hey, by the way, I sold these 3 properties and got the stock option. All that happened last year. What can I do about it? And we're like, nothing. It's January 1st. That was last year. But we can help and add a lot more value with our clients during the year to proactively tax planning. And let's create a strategy. And if you're going to stray from the strategy, we need you to call us. We need you, or you need to work with your CPAs. If y'all come up with a strategy and you change something, or something happens that you can't turn down, call your CPA, work with them, and make sure you're doing it in a tax opportune way. There's 1 or 2 different words in a contract can change the complete world for taxation. So we're big believers, and we love it. Tax planning is where we add value and where your CPAs can add value to your lives. Tax preparation, it's a necessary evil. Kevin and I would be lying if we said we love tax season. We don't, but it's truly important that all of the tax strategies and planning and optimization strategies we came with other clients are executed correctly on the tax return. Like Kevin gave the example of our client that got the cost segregation. The CPA didn't do anything. We can do a lot of tax planning, but if you don't do it right on the tax return, you don't get it. But again, working proactively is the way that you mine opportunities out of the tax code. And it helps you be proactive in planning with the tax code and use it for your own financial freedom versus being a victim of the tax code.
Yeah, I completely agree with you guys. I mean, till a few years ago, for me, it was all about tax preparation, and that's when I would contact my CPA. But now with the tax planning part is so much more important if you want to, and especially if you're doing it in the beginning of the year, so you can strategize and your acquisitions around that. Such valid points. So I was just going to open it up now to people who want to ask questions. Bindu, you have your hand raised, so you can unmute yourself and go ahead. And then I'll also look at the Facebook chat and grab some questions from there because I know people have been posting.
Okay, hi. So I have a couple of questions. One is the best way to actually keep track of your expenses. Is that just an Excel spreadsheet where you write down Amazon, this is how much I spent, and sort of like, or do you put in Amazon, you know, supplies, and these were the supplies, and so how much detail do you need when we do maintain expenses?
Good question. We typically recommend to have an actual accounting software. So QuickBooks Online is what we typically recommend, and there's a couple of reasons why. Excel spreadsheets can be lost. You could lose your computer. QuickBooks Online is going to be in the cloud. So all your records are going to be on, they're going to be safe. And with QuickBooks Online, you can actually code things. QuickBooks will actually code them, memorize transactions. So as you go to make recurring transactions, the accounting will almost be automated. But on top of that, you can also take pictures of your receipts, link it to a certain expense item. And so let's say, I mean, the IRS has 3 years to audit you. So let's say at the end of year 3, they come back and audit you. Well, now we have the accounting file, and we could just go in there and click the expense. I got my receipt still in there in the cloud, and I can defend it. So the Excel can work. I mean, there's no IRS rule saying you have to have a formalized accounting system. It's just kind of a best practice to get one so that reporting and defending an audit would be a lot easier than if I have an Excel sheet and we have to drill down, go hunt bank statements. And if you have commingled bank statements with properties and your own personal expenses, now we're talking your IRS fees, your defense fees. I mean, that audit could be $8,000-$15,000. Who knows?
Yeah. Kevin and I, we're CPAs, so we like our accounting software. It's a double entry bookkeeping system. We love it. That's what we learned, debits and credits from school. But it also, like Kevin says, it makes it easier for audits, but it makes it easier for us to prepare tax returns. More importantly, it keeps real-time financials, so it allows us to do real-time tax planning with our clients. I'll be honest with you, a lot of our clients don't like using QuickBooks Online, and they want to continue maintaining their books and records. So they use something simpler. A lot of our clients like Xero better than QuickBooks Online. Kevin and I don't, but that doesn't mean Xero isn't a great software. Another software that we've come up a lot lately, it seems like it's taken off like wildfire, at least amongst our client base, is a software called Stessa. That's assets spelled backwards. It's not a traditional bookkeeping system, but it is free and it is made for long-term rentals, though I've noticed it works well for short-term rentals. And like QuickBooks, you hook it up to your bank account, you hook it up to your credit card, and it brings in all the transactions. And it's really, they try to upsell you on a bunch of stuff, but it's free. So if you don't want to pay for QuickBooks, you might want to look at that. And I know my clients tend to like it more. I think it is probably more user-friendly to a non-CPA. And finally, I just go back to what Kevin said earlier about an earlier question that Param asked was having a separate bank account and credit card for each of your activities can make your accounting and bookkeeping so much easier. If you have to go pull transactions from different accounts, it can get really difficult, really time consuming. And I'm not gonna say it'll drive your CPA crazy, but it certainly can drive your fees up with your CPA. So use a separate bank account or a separate credit card or both for your business activities. Yeah.
Yeah, and just about on the same topic, Mike, in terms of Stessa, is there a portfolio size beyond which you feel like it's better if if you're just using QuickBooks Online as opposed to Stessa?
I haven't seen the cutoff. I've seen a client where we have, I think, close to 24 properties. And It seems to work pretty good on it.
Okay.
But he's using different bank accounts for each of the properties, so it automatically knows to code those transactions to the properties. If you're using one bank account for a bunch of properties, I think Stessa can get pretty difficult, or QuickBooks is a little bit easier to classify it. So I wouldn't say it's more of a size thing. It's kind of a complexity thing. If you have long-term and short-term, and we've got to track those separately, Stessa can be a little bit harder to filter your reports like we could use in QuickBooks Online. So I don't think it's necessarily amount of volume of properties. It's more complexities.
That makes sense. That makes a lot of sense. Does anyone else on Zoom? Maya, you have a question? Just feel free to unmute yourself.
Param, this is Sadhna. And
Hi.
so, hi. So I have a question for either one of you, but suppose we go ahead and do a short rental, purchase a short-term rental, and we do the material participation. The next year, can we turn it over to a property manager?
Absolutely. So that is a great strategy, and I'll kind of share kind of what some of our clients do. They want to start growing and diversifying their assets in real estate. They eventually want 10, they eventually want 15 properties. And they want to also at the same time utilize depreciation. So what they do is exactly what you said. I'm going to buy 1 or 2 properties a year. I'm going to materially participate and manage those properties, meet the hurdles to deduct the bonus depreciation. Then once I do the cost seg, I'm going to harvest that depreciation against my taxes. Then the next year, I'm going to flip it to passive. I'm going to get a management company, because at that point, no one cares. You've already taken the depreciation. There's no benefit anymore for you managing that property. Now, in the next tax year, go buy another property or 2, manage those 2, get the depreciation off of it, flip it to passive. Now you have 4 properties under passive, and you just kind of keep snowballing in that way. So it is a very common strategy, and you're not required to keep maintaining material participation throughout its life. It is a year-by-year test. So even though you meet it 1 year, you may not meet it the next, nor may you want to.
So question on that one. So
Thank
say
you.
we do take a whole bunch of, so that you do bonus depreciation the first year, that you do materially participate, and then say not all of it is deducted from your taxes because say you had expenses or whatnot that were applied. So a little bit of the bonus depreciation is carried over to the following year where you're not materially participating and you have a passive, now it's a passive investment. So in that case, can you still use that bonus depreciation the following year that you've carried over as an active loss?
So what you classified is called a net operating loss. And that happens on your general tax return at a higher level. So let's say you take $300,000 of bonus depreciation, you have a $300,000 rental loss, but your W-2 for your practice is only $200,000. You've taken more depreciation than you even had income. So that $100,000 delta, that is going to carry forward to the next tax year as called a net operating loss. And that is going to be deducted next year against your W-2 income. So you're starting the next year already off, minus netting, I guess, a negative $100,000, whether you materially participate or not. It's no longer subject to passive activity loss rules at that point because you've locked it in as a net operating loss, and net operating losses are going to carry forward until utilized. So there's no issue there.
The same thing goes in the reverse though. It's so once active, like Kevin says, it's always an active loss. But if you have something that's passive, you don't want to take a cost seg if you think it's going to be active the next year, because once passive, always passive, unless you get rid of the activity. So that's kind of the rule of thumb that we learn. Once active, always active when it comes to losses. Once passive, always passive.
Yeah, that makes a lot of sense. Christine, did you have a question?
Yeah, so this is actually pretty specific, but we had a property, short-term rental that we purchased at the end of November. We were able to get 2 separate rentals out of it before the end of December after fixing it up and furnishing the property. But we failed to get our Airbnb account linked to our LLC checking account fast enough. And so the year ended. And so the money that was paid for those rentals wasn't actually transferred to us from Airbnb until the new year. So can we count those for last year, or are those now considered money transfer for 2022?
The cash actually hit your bank account in 2022?
Yes.
Yeah. So you are what's called a cash basis taxpayer. You're going to report income in the year that you receive it, and you're going to report expenses in the year that you pay them. So you are going to record that income in 2022, even though you earned the rents were earned in 2021, you never actually paid until 2022.
But wouldn't you say that her property was in place in service in 2021?
Yes. Oh yeah. It was rented. I mean, you had a renter in there, so you almost get the best of both worlds. Your property's in service and you don't have to pay the tax till next year.
So you're
Thank
eligible to do the cost segregation for 2021 then.
Yeah. Yeah. As long I know that you said you didn't have your Airbnb account up or linked or whatever. We just need to prove that it was occupied, that you had some sort of an agreement there. They signed some sort of rental agreement. And if you can prove that, and we can even just prove it was in service, I would be more than comfortable defending that. Yeah.
Okay. And it was through Airbnb, and the money got paid to Airbnb. It's just Airbnb couldn't transfer the money to us until the new year because we didn't have an account linked with them.
Yeah. Yeah. You're gonna record the income in the year that you receive it.
Okay.
Although we do have a newer client this year that has almost exact, except it wasn't rented off of Airbnb. It's just the management company didn't get the money to them until January. And I explained to him that he's just like Kevin did. He's in a perfect situation. It's fine. It's the best of both worlds. But he was concerned. He said, do I have a little more risk for getting audited? And like Kevin said, who cares if you get audited as long as we can back you up with it? We said, do I have a little more risk of getting audited? I had a horrible audit 8 years ago. I don't ever want to get audited again. I said, potentially have more of a risk if you don't show any revenue. So he's asking us to put that rent, even though he didn't receive it until January, on the 2021 tax return. And we're willing to do it because the IRS never care if you pick up income early. They care if you take expenses early, but if you pick up income early, they don't care. We're doing that just to ease his mind that it's going to reduce slightly his chance of being audited. We just have to remember not to double count it next year.
Yep.
Okay, so I have a question from the Facebook community, and Iqbal asks about material participation. Can it be 50 hours by one spouse and 50 hours another spouse to meet the 100 hours material participation test?
For short-term rental properties, yes. Long-term rental properties, no. So with short-term rental properties, you both, husband, wife, spouse, can work together, work a property, and we can double count essentially your hours. If both of y'all spend an afternoon fixing the flooring or fixing something up at the property, we're counting your hours. So yes, you can both do 50 hours, get to your 100. If you're trying to meet the 100-hour test, we just need to make sure no one else is producing activity more than you two.
Okay, so Iqbal also asks, if you have multiple property managers for multiple properties and you're managing them, do those hours count towards material participation?
The time spent working with your management company, yes. Yes.
And his other question is about listening to, I guess, education, listening to real estate podcasts, webinars. Do education hours count towards real estate professional status?
Yes.
Okay.
Everyone here gets an hour.
Make sure you log it right now before you forget to log
Yes.
it. So Judy asks if you work in all states, work with investors and physicians throughout the country, essentially.
Yes. The odd thing of COVID is how it kind of opened the door to virtual business for a lot of people, and that included us. So we have clients all over the country. I think Mike and I, we have a brand new office in Texas that was built, and I think we've seen maybe a handful of clients there in 6 months. So the normal working business is just like this. We are meeting over Zoom. Our schedules are open to that. I have clients in every state. Different state tax issues can come up, and we have the ability to research them. Mike and I will definitely tell you when we're kind of wading into waters where we don't know the answer. We're never going to tell you we know the answer to something we don't. We want to be very honest and saying, hey, I don't know bonus depreciation rules in Washington. I'm a Texas CPA. I know Texas, Florida, Tennessee. I know Colorado. Those are very hot spots. Georgia, I know that. We know how depreciation works there, but if you're going to get into a real estate market that we are unfamiliar with, we'll tell you, but we're also going to find the answer. We got great research capabilities.
That's
Yeah,
great.
the only area where we sometimes try to bring in local specialists is when you get into really specific things like local permitting, zoning, getting the licenses for short-term rentals. Every city's got its different rules, and that's not us. We usually try to find an attorney in that area. We will work with every state. We do work with, I think, every state. Yeah, every state. but we'll also tell you some states aren't the best states to be in if that's where you want to lower your tax and build your wealth. So we don't love all of the states, but we'll work with all of them.
Well, Jan asks about Florida, and I know you mentioned this, Kevin. So yeah, so Jan, so they're very comfortable with Florida. I have another question from Iqbal. So Iqbal's question is, if I buy a property in my personal name and then move it into an LLC, can I still get tax benefits?
Absolutely. So it's very common for people to buy property personally before they even have an LLC established. A couple of reasons why. Someone's not going to lend to you with a brand new LLC. You have no history, you have no business, you just have nothing backing it. You're going to personally guarantee the loan. So it's very common for everyone to buy property personally. You're going to incur expenses personally. So you're going to be paying money out of your personal bank account until you get established. So we just need to make sure we account for that. And then when we get the LLC set up, transferring everything, the mortgage, transferring things into the LLC, then taking all those expenses you incurred personally and journaling them into hopefully your accounting system as an owner contribution of those expenses you paid personally. So yeah, it's not going to be a problem. On the tax side of things, you're going to deduct things the exact same if you had an LLC versus if you did not have an LLC. We just recommend LLCs from a liability protection standpoint. It's not a tax issue, it's more of a liability issue. And if you don't go with the LLC route, at least have an umbrella policy covering you in the event that you were ever to get sued. People get sued for all sorts of crazy things. And in the short-term rental business, depending on, especially if you're going to be in a party city in Florida, you're going to want some sort of liability protection there because who knows what's going to be going on in your house. So if you were to get named in a suit, at least have an umbrella policy to cover you. The worst thing is going to have everything personally held, and then someone sues you and all your physician work, all that's up for grabs. We don't want that. So that's where an attorney is going to be worth their weight in gold.
Yeah. And I guess last question for you guys, Mike and Kevin. So Ted asks, so if I am using bonus depreciation and I'm using it to offset active income with real estate professional status, just taking all that bonus depreciation, does that reduce my ability to offset future passive income? And what is the point of all of this if the IRS is going to, I guess his question is, what's the point if there's going to be depreciation recapture at the end anyways, is his question.
The time value of money, right?
Yeah.
So if you're gonna, the whole main crux of tax planning is kicking the can down the road. And I'd much rather keep $100,000 of my income this year and pay $100,000 to IRS 10 years from now, and hopefully turn that $100,000 into 10 times that 10 years from now, than just give it to the IRS and let them go do what they do with it, which generally isn't very helpful. It seems to just disappear. So the time value of money is the number one reason. What else would you say, Kevin?
Yeah, I think just saving your money, like Mike said, we can't eliminate the income tax. The only true way to eliminate income tax is going to be with the step-up basis rules upon your passing. So at that point, the strategy would be you hold on to all your real estate, you get your basis down to zero with depreciation, you save all your tax, you hold on to it till you die, then you give it to your kids, they get the step up in basis and then sell the property. Now we have eliminated income tax. Everything until then is deferring income tax, get you money today, let you use and reinvest that money that you saved back into another property. So like Mike said, in that 10 years, you would have paid that 100,000. You could have bought 3 or 4 more homes, done 3 or 4 more cost segs, got some more depreciation, some more tax reduction, and redeployed that into, you're snowballing your portfolio quicker. Assuming you're making wise investments. If you do the cost seg, get $100,000 tax savings and stick it into a savings account, true. I don't know what we're accomplishing there. You have available safety net of cash, liquid cash, but you want to be growing it, working it, and being wise with it.
Yeah, and we have a couple of more questions, but just to add to that, when you're doing depreciation recapture, Mike and Kevin, you're doing it at your marginal tax rate in that year that you're recapturing it, correct? So you may be in a different tax bracket at that point potentially, and that's only for bonus depreciation, because with regular straight line depreciation recapture is 25%, right?
Yep.
Yep.
Okay, so we'll just take these last two questions and then call it a wrap. So Maya, if you want to go first. Sadhna?
Yes, so my question is, so in order for material participation where a husband and a wife can combine their hours, so does the husband have to be listed on the property as well?
No.
No.
Nope.
Okay. All right. Thank you. That was my question.
But you do have to be married filing jointly. You can't be married filing separately.
Okay.
That's a great point.
Yeah, and in some states, it makes sense to file separately. So in that situation, we want to make sure that we're not going to be solving one problem and creating another. So you don't want to just blindly, okay, we're going to file joint and then get killed with some other blind thing that you're not aware of. So
last question, Bindu, go for it.
I have a question. So this year I got an STR, I materially participate, I'm able to bonus depreciate. So next year that property is passive, but I buy a new property and I'm going to materially participate in it. Is there any benefit to keeping track of time for this property number one and property number two? Does the time from property number one help me with material participation in the second year?
no, you're talking short-term property? Yes. So when it comes to short-term property, until you get to about a 5 or 6 property where you have a kind of a portfolio or a holding company holding 4 or 5 of these properties, it's going to be a property by property basis. So because we're not taking the stance that, like in long-term real estate, we make that election and you materially participate in the bucket. With short-term real estate, I need you materially participating for each house. So in this example, you could have 2 homes. You could be actively managing the property up the road from you. You could be working the property, changing the sheets, cleaning it. You could be substantially providing all the material participation for house A. Then you have house B in Florida, halfway across the country, that you have a management company for. I cannot make the argument that both are materially participating active properties because the circumstances are different for each property. So we need to track time by property when it comes to short-term real estate. And long-term real estate, we have that luxury of just making an election and then grouping all of our activities together. So does that kind of help? Does that answer your question?
Yeah. So for the next year, basically whatever hours that I put in for the new property is what counts towards material participation for that property.
Correct. I would log property by property, and then once it's passive, no sense in really recording your time.
Okay, great. Thank you.
Just let it be passive. Enjoy the mailbox money.
This has been great. Thank you so much, Kevin and Mike. For all those of you listening, Kevin and Mike are with Pine and Co CPAs. I have a link in the description, and I will send links out when I send out this recording. Also, they do free 15-minute consults. If anyone wants to, talk about your specific situation before engaging their services, feel free to do that. And so, like we were talking about today, it's not just about tax planning, because I know it's like the time of the year when everyone's just trying to get their taxes filed. It's also about it's not just tax filing, it's also tax planning and strategy. And so, they're just so knowledgeable. You guys heard them. So definitely reach out to them for that also. I think it's super important, especially as real estate investors, we're trying to scale rapidly. Your strategy is very important. Thank you, guys.
Thank you, Param.
No, thank you. And we look forward to speaking with you all in the future. So thank you so much.